this works. Thanks, Les. So as you guys can see with the previous presentations, I think there's a common theme throughout. Tax is bad, and there's a lot of complicated new rules that are really going to curb a lot of the tax planning strategies we implement. And unfortunately, with my presentation, it's not going to change. So I'll get into it. So and for those of you who don't know me, I'm a tax principal in the tax group. I actually specialize in owner-managed businesses, so I really don't deal a lot in the public company sector, which I know our firm deals with. So this is right up my alley, and I'm going to talk about a lot of the small business deduction changes that were announced in March with the budget. So I'll go over just a little primer. So for those of you who aren't familiar with small business deduction, I'll talk about the proposed changes as it relates to partnership structures and corporations, and then I'll just add a little tidbit about personal taxes that I'm sure a lot of you guys will be interested in. So as a show of hands, how many people are familiar with the small business deduction? Okay, good. So you guys will be very familiar with this primer. I know a lot of people in this room. When I look around, I know a lot of us advise clients that are CCPCs, Canadian Controlled Private Corporations, or we ourselves have our own corporations. So these proposed changes will greatly affect us. So for just as a quick reminder to people, Canadian Controlled Private Corporations are eligible for the small business deduction, and this basically allows a nice reduced corporate rate of 13% on the first $500,000 of active business income. I always get the question from clients, well, what is active business income? It's really defined by what it's not, and active business income is not specified investment income. So specified investment income is really like income from property like dividends, interest, royalties, rents. So if you don't have that kind of income, you likely have active business income. So if you're a manufacturing company, if you have consulting income, professional services like you're a lawyer or accountant, that would be active business income. So what ends up happening is on the first $500,000 of your active business income, assuming you're a CCPC, you get this nice 13% BC and federal combined corporate income tax rate, and anything over and above your $500,000 of taxable income is taxed at the bad general tax rate of 26%. So what that allows essentially is a deferral of taxation. It doesn't completely eliminate taxation, but you get to pay 13% now, and you pay the rest when you eventually extract that money from the corporation, like you pay yourself a dividend, for example. One of the other concepts that's really important with the small business deduction is the small business limit of $500,000 is shared among associated corporations. So the term association is really corporations that are controlled by the same person or group of persons. So if I, Jamie, had 5 companies, I wholly own them, I control all of them, all 5 companies would have to share that small business deduction limit, small business limit of $500,000. So I could allocate 20% to each company, or I can allocate 10% to one company, 30% to the other, and so on, up to the amount of $500,000. And again, any income over and above that $500,000 threshold would get taxed at the 26% rate. So another key concept with small business deduction is, which actually surprises a lot of people, is related individuals don't necessarily have to share the small business limit. So if you think of a husband and wife who have 2 separate companies, one's maybe doing consulting work, the other person's an accountant, they have completely separate businesses, they each get their own small business limit of $500,000. So between the couple, you could have $1 million of small business limit that you could use for the 13% rate. And just one other comment, it's a kind of a jab at the government. They had initially planned to reduce the small business rate on the federal side. So that 13% rate that I just talked about consists of the federal rate of 10.5% and BC of 2.5%. They were supposed to reduce it to 9% on the federal side by 2019, and that's actually not going to happen anymore. So it's going to be 10.5% for the foreseeable future. So that's kind of a primer on how the small business deduction works. I'll kind of go over the rules of how it works on partnerships and then later on corporations. So with partnerships, so if you kind of think of a very simple example, think of a law firm or an accounting firm, because this is really who it's going to affect. They actually have to share the small business limit among all of the partners. So if you think of a law firm that has 10 partners, unfortunately, not each of the partners get their own small business limit. They actually have to share that $500,000 among all the partners. So you can imagine if you had like 50 partners in a law firm or an accounting firm, at the end of the day, if you're a small potato, you're probably not getting any of the small business limit, and the majority of your partnership income distribution will be taxed at that general rate of 26%. So that's the term specified partnership income. You can see it's just basically a pro rata of the small business limit. So if you're a 10% income partner, you basically would get $50,000 of the small business limit, and anything over and above that, you'd get taxed at the 26% rate. So again, just this as a simple example, and I have an absurd amount of examples to hopefully make this a little bit interesting and easy to follow. If you have a partnership, so just imagine an accounting firm, you have 3 partners, corporate partners, they would all have to share the small business limit of $500,000. If each guy owned 1/3, they would get about $167,000 of the small business limit, and any income that's distributed to them over and above that 167 is taxed at a 26% rate. So obviously, this is a pretty simple structure. From that, people started getting, creative with their tax planning. They said, if you think of this partnership and you think of me as a partner there on the left side, I would say, well, I kind of want my own small business limit. I don't really want to share it with my other partners. I'm going to introduce a management company, and this is a very common strategy, especially among law firms and accounting firms. What would end up happening is the partnership would distribute the income to the partners, to each of the respective partners. The management company that would be incorporated, so it would be normally a holding company of the partner co, it would provide management services to the partner co. Partner co would pay management fees up, and that would essentially nullify the partner co's income, so that it's essentially not really paying any taxes, corporate income taxes, and all of the income, call it $500,000, is sitting now in management co. And what you actually end up having is management co is obviously not a partner of the partnership, and you don't have that term specified partnership income, so it actually ends up getting its own small business deduction. And if you look at, there's 3 partners, each guy would get their own small business limit, you'd actually have $1.5 million among that entire group. So a very creative and commonly used strategy, and I'll kind of go into what's going to happen afterwards. This is another very common example among law firms and accounting firms. It's called a sidecar professional corporation. It's a little bit simpler in that you only need one corporation to do it. In this case, the individual would be a partner of the partnership, so not its corporation. So in this example, you have the individual partner owns 10% interest in the partnership, and the individual would incorporate a service co. And what would end up happening is the individual partner would provide marketing services to the partnership. So it would receive a nominal amount of income from the partnership, so not enough to have any adverse tax consequences. And Service Co would actually enter into an agreement with the partnership whereby the Service Co would provide the professional services, so legal services, accounting services, and the partnership would pay the money, the fees to the Service Co. And again, similar to the previous example, Service Co is not a partner of the partnership, and it would get its own small business deduction of $500,000. So, if all the other partners did the same strategy, they would each get their own small business deduction limit of $500,000. So this, again, was also a very common strategy. It's still being used. Ironically, in 2006, there was an advanced income tax ruling with the CRA, and the CRA actually blessed this strategy, and they said, yep, that's fine. Service Co can actually have its own small business limit. So, lawyers and accountants all over Canada were very happy with that. So, as we know in the tax world, all good things must come to an end. With the budget in March, they announced this new concept called the designated member, which looks at CCPCs that are providing services to a partnership. And this will actually apply for tax years beginning after March 21st, 2016. So for most of you who have a full year end, this probably won't kick in until your 2017 tax year. So essentially what happens is it's a look-through rule. And if a CCPC is a designated member, it is now actually deemed to have specified partnership income, even though it's not a partner. And it can only claim the small business deduction on its income that's connected to the partnership and to the extent that the partnership allocates the small business limit to it. So you're almost getting back to that very first example that I went over where you're only getting your pro rata share of the small business limit, and it's trying to wipe out those tax planning strategies. So just for further clarification, the definition of a designated member, and keep in mind of that example that I went over, it's a CCPC that provides, and here's a key term, directly or indirectly services to the partnership. It's not a member of the partnership. It has a shareholder that holds an interest in the partnership or is related to a person that holds an interest in the partnership. And lastly, it does not derive at least 90% or more of its active business income from unrelated parties or partnerships other than the partnership in question. So just some key points here without, it's an overly cumbersome definition, but the term directly or indirectly is really important. The term indirectly is really trying to find those situations where people are trying to maybe use multiple corporations to avoid having a CCPC directly provide services to the partnership. The other key point is it affects someone who is related to a person that holds an interest in the partnership. So if, for example, I'm a member of a partnership and my wife is providing services to the partnership through her corporation, perhaps she's providing marketing services, she could actually potentially be caught under these rules, and she might not even get the small business deduction on that income that's coming from the partnership. And the last point is really what most people are going to hopefully rely on. It's the de minimis exception. It says basically, as long as at least 90% of your income is, for the CCPC, is coming from other sources, meaning the income or the services that are coming from the partnership is really small in relation to your overall income, you're actually okay and you're not considered a designated member, and you won't have a limitation on your small business limit. So some key points here again, sourcing of the income now becomes really important. You really now have to figure out, where is my income coming from? Is it coming from the partnership? Is it coming from another source? Because again, income tied to that partnership could be tainted in the sense that the small business limit might not be available. The use of management fees with management companies or holding companies is really going to fall apart. Service corporations again are likely not going to apply anymore. And like I said, you have to be really careful about situations where you now are a partner, for example, and you maybe have a spouse or another related party that's providing services to the partnership, because they may be affected by this. So just to go over the example that I went on the sidecar professional corporation, you'll see now the service co is now considered a designated member. It's receiving, just to go over the rules, it's receiving income from the partnership. The service co is not a member of the partnership. Its shareholder, it has an interest in the partnership, so that third criteria is met. And lastly, assuming that the service co's income from the partnership does not represent, it represents more than 10% of its overall income, it would actually be caught under this. So what would end up happening again is the income that service co receives from the partnership is not eligible for the small business limit unless the partnership allocates a portion of it. So in all likelihood, what would happen is the individual partner would has a 10% interest in the partnership. It would likely allocate that 10% over to the service co, and the service co would get a $50,000 small business deduction limit. Similarly, with the tiered structure, it's likely that the management companies would now also be considered to be designated members. It's not quite as obvious as the sidecar professional corp, but in all likelihood, the management companies might be viewed to be indirectly providing services to the partnership via the partner co and the services that are between those two companies. Again, it's all the other tests are met. Management co is not a member of the partnership. It's obviously related to the partner co because it wholly owns the shares, and assuming management co has no other business other than receiving the management fees from partner co, it would be caught under these rules. So if you kind of listened to that and thought, well, I'm probably safe, I don't deal with partnerships, I'm not a lawyer, an accountant. Unfortunately, it affects corporations as well. So situations where you're dealing purely with corporations, this also affects you. So again, just a quick primer, the small business limit is shared among associated group of companies. So if I own 5 companies, they all have to share the small business limit. 2 related parties can actually each have their own respective small business limit unless there's some cross ownership of the companies. So I'll go over a quick example because this is where I find the rules to be most punitive and in my eyes quite offensive. If you assume in this example where a wife wholly owns Supplier Co., you have another company, Business Co., that is owned by a bunch of unrelated parties. They own 99.5%, so pretty much the entire company, but the wife's husband owns a nominal percentage, 0.5%. Let's just pretend the husband is an employee of Business Co. Maybe he had some share options that he exercised. So husband owns a very small percentage, wife owns 100% of Supplier Co. And Supplier Co. Enters into an agreement to provide consulting services to Business Co. And let's pretend that Supplier Co.'s income from Business Co. represents 40% of Supplier Co.'s overall income. So it's substantial. It's more than 10% of its overall income. Under the existing rules, each company would actually get its own small business limit. So again, Wife Co. has no ownership in Business Co. So Supplier Co. would actually get its own $500,000 small business limit. Business Co. would get its own small business limit of $500,000 as well. So between the two, $1 million. This is very common. You see this happening all the time. You wouldn't even think it's an aggressive tax planning strategy. That's just the way normal commercial activities operate. So again, all things must come to an end. There's this new concept now with corporations called specified corporate income, which looks at CCPCs that are providing services to other private corporations. And similar to the partnership rules, it applies for years beginning after March 21st, 2016. So specified corporate income is bad. It's not eligible for, it's basically not eligible for the small business deduction limit unless the private corporation assigns a portion of its own small business limit to that CCPC. So the definition of a specified corporate income, just to further elaborate on it. So specified corporate income of a CCPC occurs where the CCPC receives income from services or property provided to the other private corporation. The CCPC, its shareholder or someone related to the CCPC or its shareholder has an interest in that other private corporation. And the CCPC does not derive at least 90% of its income from other unrelated parties other than that private corporation in question. So again, in simple terms, specified corporate income can occur where a CCPC provides services to a private corporation and a shareholder of the CCPC is related to a shareholder of that private corporation. And thinking, again, in that example I used where you have a wife and a husband. So the rules are really punitive. I'm surprised that finance released it in that way. I mean, if someone owns 0.5% in that other private corporation and is related to that CCPC, you're caught under these rules. Usually the finance will have, I'll be a little bit more lax. They'll usually have de minimis exceptions. In this case, I have no idea why they didn't. So going back to that example where you have wife wholly owning the supplier company, husband owning 0.5%, and Supplier Co. is receiving consulting services or fees from Business Co. In this case, it's that income that Supplier Co. receives from Business Co. would be considered specified corporate income. Because again, it's receiving income from another private corporation, that test is met. The wife is obviously related to a shareholder of Business Co. That test is met. And at least 90% of Supplier Co.'s income is not derived from other unrelated parties. In this case, it receives 40% of its income from Business Co. So again, those tests are met, all those criteria are checked off, and unfortunately, Supplier Co.'s income that it receives from the Business Co. Is not eligible for the small business limit unless Business Co. assigns a portion of its small business limit to Supplier Co. In that particular case, I find it funny because, if you think of this example where you have Business Co. that's owned 99.5% by unrelated parties, it's really unlikely that Business Co. is going to give any of its small business limit to Supplier Co. unless for some reason it can't fully utilize its own limit. But in these types of transactions, you're probably not going to see any kind of allocation being pushed over by Business Co. to Supplier Co. So the question everyone's going to have is, well, do these rules affect me? It's not going to affect everybody. Obviously, if you're a sole proprietor, and these rules are more in the context of those partnership rules. If you're a sole proprietor, for example, you're a lawyer, accountant, you're just kind of operating on your own without any kind of corporation, these rules won't affect you. If you are an incorporated sole practitioner professional, so you're just kind of a one-man show, you're not in a partnership, this rule will probably not affect you. Corporations where all your income is drawn out by salary, where you are essentially nullifying the taxable income in the corporation, that's not going to affect you because there's nothing to tax in the corporation. Everything is just going to get T4 to you and taxed to you personally. And for those incorporated partners who are already just taking their pro rata share of the small business limit, so they're not doing any kind of creative tax solutions, they're just going to be in the same shoes in that they will just have a pro rata share of the small business limit. So that's kind of, in a nutshell, the changes on for partnerships and corporations as it relates to the small business deduction. I thought I'd go over some quick points on personal tax that I'm sure a lot of you are probably already familiar with from the budget. So the top marginal rate has increased. We're paying a now absurd 47.7% tax on income, taxable income over $200,000. It used to only be 43.7%. So our top rate is looking very close to Ontario now, which is ridiculous. The fitness and arts family tax cut and education credits will be completely eliminated by either 2016 or 17. 2017, they're either going to get reduced in 2016 or just completely wiped out. And just the last bullet point, this is not really from the budget, but it was recently announced. The sale of a principal residence, a lot of people don't realize that technically under the legislation, you actually have to file a form to report the disposition of a principal residence. The CRA, surprisingly, one good thing they gave us over the years is you could actually not file the form. Administratively, they would say you don't have to file it as long as your full gain is exempt under the principal residence exemption. And I suspect now with obviously rising housing prices and house hoppers and trying to avoid tax on the sale of houses, they have now actually removed that administrative policy, and that they actually do want you to now report information about the sale of your principal residence on your personal tax return. So that will be effective for the 2016 year. So just in closing, there's obviously several new rules to restrict access to the small business deduction. I tried to just kind of quickly go over it. The rules are really complicated. There's a lot of rules a lot of situations that I didn't even anticipate would happen until I read the legislation closely. So do review your corporate structures carefully. It's not good to just bury our heads in the sand and assume it's not going to affect us. And a lot of times it will if you have intercompany transactions with partnerships or other corporations. consider some alternative structures to maximize the small business deduction claim. It's not always likely feasible, but you may want to consider, if you're in a partnership, winding up the partnership and just having a cost sharing arrangement, so you're basically getting rid of the partnership structure altogether, and you guys are just you and your partners or your ex-partners are essentially just sharing costs amongst each other. And lastly, the simple alternative might be to simply wind up the corporations. That sometimes keeping it simple is easiest. And so if you have the tiered structure, or you have the sidecar corporation, you might just simply want to wind it up and just keep things simple. So with that, that's the end of my presentation. I'll just turn it over to Les real quickly.